I'm your host, Bill Borton. Back in the 1980s, the muni bond company Nuveen used to say, it's not how much you earn, it's how much you keep. When it comes to retirement income planning, many baby boomers seem to forget about the tax part of the income plan. My guest this week is John Blake. He's a CPA and partner at Klatzkin Accountants and Advisors. He's a tax strategist for high net worth individuals, small businesses, and entrepreneurs. Welcome, John.
Well, thanks for having me, Bill.
Yeah, my pleasure. So, John, what's one of the biggest issues that boomers are facing as a result of having deferred all those taxes for all those years into their qualified plan?
They're facing a lot of issues. So they have to deal with the current tax rates. When they were planning out deferring that revenue, they didn't necessarily know what the tax rates were going to be at the time. They had to start taking distributions.
We were all told that we were going to be in a lower tax bracket when we retired, right?
We're all told that. Everybody breaks out their crystal ball. Everybody knows what's going to happen in the future. That's not necessarily the case. So honestly, when you look at historically, tax rates previously, before 2018, were higher than they are for 2018 through 2026. So now for baby boomers, it might be a good time to start taking distributions before they hit 70 and a half.
Really?
Absolutely.
Okay. Well, so we've always been told that you take taxable or tax free before you take tax deferred and put it off as long as possible.
Right.
But, these things called required minimum distributions, or RMDs for short, have been catching a lot of the older baby boomers off guard.
Right, absolutely. So required minimum distributions are essentially, once you hit age 70 and a half, you have to take them out of your qualified retirement accounts. They're calculated based on your retirement account value at the end of the prior year, and you have to then recognize that distribution as income. You also have to look at the IRS table of life expectancy to figure out how much you have to claim and take out of the plan.
So it doesn't matter how long you're actually going to live. The IRS decides at what age you're going to croak, and then tells you how much of your qualified money you have to take each year.
Exactly. It's pretty much IRS telling you when you're going to pass away and how much you have to recognize in the current year and how much you actually have to take out of the plan in the current year. There's definitely a lot of baby boomers who weren't planning for this. They weren't planning to have that boost in their income. So it is essential that they kind of start looking at it, once they hit 59 and a half and can take distributions from their plan and not have to pay penalties on those distributions to kind of lower their total account value before they hit 70 and a half. Tax rates right now, again, historically 2018 through 2026, 2025, are lower than they have been in the past. And, again, break out the crystal ball. My guess is that they'll go up eventually. So take those distributions now while you know what the tax rate is. You know the devil you're dealing with, and, hopefully when you hit 70 and a half, what you've taken out, you've put in some sort of account that'll grow and you don't have to necessarily withdraw from.
And you may have more deductions now than you might when you're retired.
Absolutely.
As well. So that could help offset, some of that income.
Definitely. And there's definitely things that you can do now that could potentially go away in the future.
So one of the other things that I hear about to reduce the impact of required minimum distributions would be Roth conversions. In other words, you have an original or traditional IRA, and then for a number of years now you've had a Roth IRA where the money grows tax deferred and you can take the money out tax free. You don't get the tax deduction on the front end, but converting to Roth is not quite as attractive as it used to be, but it still could make sense, right?
Definitely. So when you say it's not as attractive as it used to be, we used to use the Roth conversion as a planning tool. We used to have clients convert traditional IRA money to Roth plans, and then look at their tax situation, and then knowing that we could always recharacterize that money back to Roth if we had them take too much. Back to traditional if we had them convert too much to Roth. Under the Tax Cut and Jobs Act, that recharacterization piece has gone away. So basically what clients can do now is they can take their traditional IRA, convert it to Roth, but then that's where it stops. So we have to be very careful that we don't convert too much to Roth, because when you do that, it's taxable income for our clients at the point it converts. So you want to kind of juggle the balance of how much tax they're going to pay now when you convert, at current tax rates and tax brackets versus, if maybe traditional down the road, saving some for RMD might be a better balance. It completely depends on where the client's at in this point in their life. If you want to kind of take advantage of the lower tax rates now and convert a good chunk of that plan, you could do that. And then the good thing with the Roth is that you don't have to take required minimum distributions when you hit 70.5. So you can leave that money in that plan longer if you don't need the cash.
So another thing that impacts high-income boomers in retirement when they become Medicare eligible is the Medicare Part B premium, which is basically adjusted upward depending on your adjusted gross income.
Right.
So.
Yeah, and it's something we kind of keep in the back of our mind when we're dealing with our clients. In the government's eyes, they consider $170,000 right now as being highly taxable or high tax income, and that's when the Medicare Part B premiums start increasing. That's not a lot of money. It's especially if you're a New Jersey resident, living in this state, $170,000. It doesn't go very, very far. So
that's married filing jointly.
Married filing joint,
yeah.
Correct, yes. So we definitely try and keep that in the back of our minds when we're looking at the conversions, when we're looking at the RMDs, and there's other things you can kind of do to reduce gross income, modified adjusted gross income for that Medicare Part B premium to kind of keep them under that 170 or as much as possible. So we try and do that. We try and be proactive with our clients. We try and plan it out. We look out, project out next year, knowing what the RMDs are going to be if they are taking regular RMDs. Project out into the future and try and keep that 170 in mind and keep them under that as much as we possibly can.
I've also heard that boomers who don't necessarily need all the RMD income can reduce their tax bite by giving some of the money away.
Right. Absolutely. So with the RMD distribution, the minimum distribution, you are basically required to take it out every year. If you decide that you don't need the cash every year, you can make that money, charitable donation, basically go directly to a charity. You don't get a charitable donation for that contribution, but you don't have to recognize the income. So it works out well, and basically it keeps their income down, their gross income down for that RMD amount. And again, if they don't need cash flow, they're doing something good for the community.
I've been told that a lot of boomers are being advised to set up donor-advised funds too, because they can get the benefits from it. And of course, a lot of the charities aren't nuts about that because they're not getting the money right away.
Yeah.
So.
Yeah, I mean, there's a lot of foundations that are happy about it.
Yeah.
But yeah, no, the donor-advised funds, that was something we told a lot of our clients about at the end of 2017 after the Tax Cut and Jobs Act got signed. Because under the new law, what they've done is they've bumped up the standard deduction to $24,000. So you don't get itemized deductions if you're under $24,000. So historically, you'd have clients that would be on that threshold of not getting to itemize based on that $24,000 limit. And there might be, if they're not as charitable every year, where they're not hitting that amount, save their donations, lump them into 1 year. You could do it, put it into a donor-advised fund, and then from that point forward, you direct where it goes. So essentially, you could spread it out over a couple of years like you usually would. It's just that you're getting the whole benefit in 1 year. So yeah, that's donor-advised funds. I mean, I expect to see them kind of, the popularity of them increase. I expect to see a lot of, individuals, boomers, doing almost lump sum contributions every other year to donor-advised funds type of thing to kind of hopefully take advantage of tax rules.
So what else are you coming up with to help boomers reduce the impact of possibly having higher income as a result of RMDs?
Yeah, there's some other planning techniques that we can use. So again, the RMDs, doing charitable contributions are from the RMD directly to a charity is one of the easiest things to do. Reviewing their itemized deductions to see if they're going to itemize, possibly offsetting some of the RMD with itemized deductions if they get a benefit for it in that year. One of the other things that we have kind of looked at for our clients with the RMDs is to not really necessarily give the RMD, what I'm trying to say is the clients need to review their accounts, their retirement accounts before they get into the RMD situation. So, you know, what is your balance? You try and minimize your account balance maybe before you hit 70 and a half. You know, again, because tax rates right now in 2018 are lower than they have been. They're projected to be lower for the next 5-6 years. So you look at your account balances, review your account balances, see what kind of funds you're invested in, what the projected growth of those funds are, and potentially take distributions now. You could also, and kind of a roundabout way of lowering that account balance is you could take appreciated stock and donate to that to a charity as well. And basically, what that almost gives you a kind of like a double dip of tax savings, if you will. It lowers your account balance in your retirement plan, and it gives you a charitable contribution. So, you know, again, assuming it's a year that you can itemize, you'll get the charitable contribution for a stock donation. You'll lower your account balance, which theoretically would lower your RMDs.
So now, does it make sense, and help me if my thinking's correct here, John, but if, you know, normally we always thought as a taxpayer that you would wait until after the end of January when you got all of your documents, your 1099s, your W-2s, your statements from your investments. Maybe by, you know, tax time, some of the K-1s come trickling in. But would it make sense for a lot of boomers that are looking at the potential of RMDs to start doing some what-if planning using your tax software before the end of the year?
Absolutely. Because what happens with the first year of RMD? So, you know, basically you turn 70 and a half, you are essentially supposed to take an RMD that year, essentially. What happens in the first year is you can defer taking that money out until April of the following year. So again, that is a chance for some tax planning. You know, depending on what you have in that year, you turn 70 and a half, maybe that's a year you recognize more of your stock sales or capital gains to kind of get that account balance lower. The RMD is already calculated on the year before that, but moving forward past that, it'll lower your RMDs. And then, you know, the following year you would have to take two RMDs, but you wouldn't have that huge capital gains. And, you know, again, it's a way to kind of tax plan. It'll depend on cash flow needs. It'll depend on, you know, anticipated income in the following year and the current year. So that there is definitely some tax planning that can be done around that. You just kind of have to make sure that you're not, you know, recognizing too much income all in the same year.
So what I'm thinking is that we want to talk about a little bit more about the new tax law. But right now, we need to do the good old commercial break.
Sounds good.
For a word from our sponsors.
Very nice.
This is Bill Borton. We'll be back with more with John Blake to talk about taxes and the new tax law on Live Better Longer after this commercial.
What do I want to be when I grow up? Maybe a musician? A veterinarian? Maybe an equestrian? A mommy? Well, why not be all these things and more? Consider joining me, Dr. V, with friends and colleagues as we explore a wide range of topics together. V is for variety, here on RVN TV.
There you go, Richard. Oh! Is that too hard for you?
No. Is it too hard for you?
Woo! We're playing catch now. Oh, shit.
Welcome back to Live Better Longer. I'm your host, Bill Borton, here with John Blake from Klatzkin and Company. John is a CPA and a tax strategist. So John, before the break, we happened to mention the new tax law a couple of times. Now, anytime you get a new tax law, there's people that are happy and people that are not so happy.
Right.
But when it comes to baby boomers, particularly those that are either in or planning for retirement, what things can they be happy about? And then on the converse, not so happy?
Yeah, there's definitely winners and losers in every tax reform or tax law. So for boomers particularly, one of the things that they did under tax reform is they increased the standard deduction to $24,000 for married filing joint. That's pretty much double what it was in previous years. The flip side of that is the boomers are losing their exemptions. So, you know, maybe with the standard deduction previously in exemptions, maybe they were close to that $24,000 amount. You know, it'll be interesting to see how that kind of washes out, but it might, honestly, it might even be a wash. Some of the other things that they did in the tax reform is if you are able to itemize, so basically if your itemized deductions are above that $24,000, they kind of went back and looked at the medical expense threshold that you need to get above to take medical expenses. So for what the original law was under the Affordable Care Act in 2018, that threshold was supposed to go up to 10% of your income. So you had to be above 10% of your income to get any medical expense deduction.
Your adjusted gross, not your gross top line, right?
Right, adjusted gross income. So the Tax Cut and Jobs Act reduced that back to 7.5% for retroactively for 17 and through 18. For 19, it's gone back up to 10%. But you know, for the rest of this year, rest of 2018, if you have any significant medical work to get done, try and get it in before December. So you know, they did that as well, and obviously for New Jersey residents, one of the bigger things is the state and local tax deduction cap at $10,000. You know, for boomers, it'll kind of remain to be seen whether or not they're going to win or lose from that. You know, New Jersey, it's kind of hard to find anything less than $8,500 in real estate taxes plus your state income tax. Probably puts you close to that $10,000 cap to begin with.
Well, they just send more people out of state, right?
I mean, that seems to be the trend. I wouldn't recommend it, but you know.
I became a Pennsylvania resident in 2016.
Oh, so there you go. You got out just in time.
Yeah, and my property taxes were double that number that you mentioned when I left. So, yeah, so I'm not unhappy about the new tax law for that reason.
No, and it's, you know, again, for boomers, I think a lot of them are going to be hurt by that more than the opposite upsides of the law. So like another upside is that they allow child care credit increased. That's not going to benefit too many boomers.
Well, a lot of boomers had kids later in life. You know,
This is true.
I have clients that are doing long-term care planning that are, you know, early 60s and they're still paying for kids.
And they could potentially benefit for that, for under this law, for having children under 13 or 14. They increased the credit and they made it refundable. Previously, it was $1,500 credit, kind of started getting phased out with income. It's still getting phased out with income, but it's a much higher threshold now. It's $470,000, $478,000, and part of it is now refundable, where in the past it wasn't. So, you know, if you have kids and you know, you hit that cap on state and local taxes, there's a little bit of a trade-off there. But there definitely are winners and losers in pieces of the bill. The other thing that they did under tax reform, if you were a boomer and you were paying alternative minimum tax, assuming that your income's not over $1 million, then you won't be subject to AMT any longer.
Which is a real plus, because I can recall years where I had high income, where I was really pleased with all the deductions and got the number down there, and then my accountant would remind me that the AMT came into play, and it was all for naught.
Right, and again, being in a highly taxed state like New Jersey, you tend to run into AMT because of the property taxes and the income taxes that you're paying. So it'll save clients. When we did our projections for 18, we found that clients that were in alternative minimum tax in 17 ended up either breaking even or saving money under the tax reform, simply because of the AMT, and honestly, the reduced rates have helped as well. So basically, every tax bracket in 17 has essentially shifted about 3% lower for 2018 moving forward.
So that's a plus.
That's absolutely a plus, yes.
Yeah. So depending on what state you live in and depending on how much income you make,
Right.
you could indeed be better off under tax reform.
Definitely.
And theoretically, it stimulated the economy a bit.
Theoretically, yes. Yeah.
And everybody wants to take credit for that, but
Of course.
unemployment's down and people are making more money, and I'm actually hearing that salaries are finally going up for a lot of people.
Yeah, no, definitely. And it was interesting to hear at the end of 2017 how many larger companies were giving employees a bonus based on the reform right after it was signed. So, there was some immediate fallout from it that was positive. So we'll see what happens in 18 or so years.
So what other tax planning strategies are there that you see? What opportunities are there for planning that could apply to some of the boomers out there?
Every situation is different. We definitely have to consider each individual case as we are sitting with clients to see what their goals are and what they want to do. But like I had mentioned before, donating depreciating stock to charity, donating your RMDs to charity to kind of keep your adjusted gross income down. Potentially looking at other mechanisms to save money that doesn't necessarily save you taxes right away, but down the road could save you taxes.
Gotcha.
So, maybe converting to a Roth IRA so you don't have to take the RMDs in the future, at least immediate future.
So John, I'm sure some of our viewers are going to want to be able to get in touch with you with tax-related questions. What's the easiest way to get a hold of you?
So the easiest way to get a hold of me is my email address is jblake@klatzkin.com, or my phone number is 609-337-1973.
Wonderful.
My direct line, so.
So, I know you're very client-centric and very much into planning. So when a new client sits down with you for the first time, what are some of the things that you ask them about?
So we always ask our new clients when they sit with us, especially individual clients, have you updated your wills?
That's assuming they have them.
It is a big assumption. So it's really a twofold question. It's, do you have a will, and have you updated it? We like to see that they've updated it annually. Have you updated your beneficiaries on your retirement accounts, your insurance policies? I'm sure you know all too well of the horror stories of people who have not.
You have your 85-year-old brother as your executor, and your children who are now in 30s and have their own kids are still listed as minor beneficiaries.
Right. Yeah. No, it's not a good place to be when heaven forbid something happens and you're left there without a beneficiary who's alive, or without a will. It's a mess, a huge mess that it's just not worth dealing with. So that's usually the first thing we ask, and then from there we kind of go into what it is that client actually wants to accomplish. Some clients just want to defer tax as much as possible. They're still under the old adage that what they've been taught, to defer. And others do see the benefit of paying now and possibly getting lower tax brackets today, and perhaps they might go up in the future. So again, dealing with the devil, so it really comes down to what that client is looking for and what they want to do.
Now, I know a number of your clients are small businesses, and I know that a lot of the small businesses in the U.S. are owned by boomers who have some or most of their retirement in their own minds, or in reality, or in their own minds, in their business.
Right.
And of course, business succession planning could be another whole show. But can you throw out a couple of pointers for some of those folks who may or may not have spent much time on this?
First pointer would be to do it. Again, business succession planning is one of those things that it's kind of like the will. Hopefully they've done it, but a lot of them have not. But they need to start looking at it as soon as possible. If they want to be able to sell their business for the best price possible. But you know, if they're kind of in a bind and they haven't done it, you know, a few of our clients have started to look into ESOPs, employee stock ownership plans, but they are very particular. There's strict rules you have to meet to qualify. They're kind of niche to certain companies and certain sizes, so that they're not for everybody. There could be succession planning within the family. Maybe you have the next generation of children that you want to leave the business to. But even that still has to be planned out. There still needs to be a conversation. You will have to make sure that the children want to do it. We've had a number of clients who've come in and said, oh, I'm going to leave the business to my client, or to my kids, and then 5 years later, the kid's like, I don't want any part of that. So it does happen, and then, you know, the worst case scenario is the client's left wanting to get out, and the only way to do it is through private equity.
And then they end up getting a lot less than they had anticipated.
Right.
So, and I guess you could also counsel people on how to receive the proceeds from the business, lump sum versus a stream of payments, or some combination thereof.
No, absolutely. Most of the time, clients want to try and structure their sales as stock sales. That way, when they're recognizing a gain, hopefully, from the sale of their business, it's capital gains as opposed to potentially ordinary income for some of the business sale. So it's not usually very easy to structure the sale as a stock sale. Most of the time, the buyers want to acquire the assets, so that way they have a depreciable asset to write off over the next 15 years or whatever the case may be. So, you know, some careful wording from the attorney on the sale can definitely help with that.
Interesting. So in the remaining moments that we have, is there something else that you want us to know about working with your firm? You know, why someone would choose you and Klatzkin over the other guys?
Absolutely. I mean, my feeling is that as a firm, we're proactive with our clients. We try not to be historians as much as the profession has been in recent memory. You know, we try and call our clients on a regular basis. You know, for an example, once the Tax Gun Jobs Act was signed, most of the partners were working that whole week of Christmas week, calling our clients saying, you know, prepay your property taxes in 17 if you can, because you're not going to get a benefit for an 18. So, you know, the biggest thing I would say is that we try to be proactive. There's a lot of good accounting firms out there. You know, a lot of people can do tax returns. A lot of people can do financial statements. In the end, that's our product. But really, what I think separates, you know, accounting firms is the service that we provide.
Good. Well, thank you, John.
Thank you for having
I've really enjoyed having you on the show. It's been a pleasure.
Yep, absolutely. Thank you for having me.
This is Bill Borton. We'll be back next Tuesday with more Live Better Longer on RVN TV. Thank you for watching.
Why should you choose Rowan College at Gloucester County? Low cost, the #1 nursing program in all of New Jersey. More than 70 programs of study, including selective admissions. With record enrollment. A premier partnership with Rowan University. Transfer options with numerous universities. 4-year degree options on our campus. Rowan College at Gloucester County. Now you're thinking.
Choosing Medicare coverage can be a very confusing and complicated process. Help is just a phone call away, 856-226-4800. As a licensed insurance agent, I'll assist you in making an informed and confident decision on a Medicare plan that meets your needs, lifestyle, and budget. Call me today for a free, no obligation Medicare benefits consultation, 856-226-4800.
When did you see the sign?
When I needed to create a better visitor experience.
Improve our workflow.